On today's show, 3 questions. Number 1, how should we decipher today's market headline? Number 2, is the government coming for your gains? Number 3, are you waiting for your parents to die? Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
Hey, guys.
What's up?
Rabih always has that wry little smile. He's just always waiting for me.
Keeping me on edge.
Yeah. Rabih, have you had a donut today yet?
Oh, no. I'm waiting till after lunch, so I'm responsible. Because I know if I eat it before lunch, you guys will not have any. I'll finish the box.
You'll just go? Okay.
Yes, so.
For those of you that don't know, this show is unofficially sponsored. It's not sponsored, but it is unofficially sponsored by Fresh Donut and Deli in Salt Lake City. It is the greatest donut. Their maple donuts are the best.
Is that what it is? Just maple? That's the go-to?
It's just a maple glazed donut, man. It's the best donut I've ever had in my life.
Okay.
So Fresh Donut and Deli was, I'm not just joking, like it was truly ranked, I think, top 25 donut places in the country by some food publication. So it's legit. It's like legit donut place. If you're ever in Salt Lake, check it out. Fresh Donut and Deli.
Would you say donuts are the best American sweets?
Oof, it's a good question. I mean, I love donuts.
Donuts are weird because they're kind of positioned as like a breakfast, like a breakfast type of treat, but they don't seem like, I don't feel like I go to dinner and then later I'm going to have a donut after dinner, as a dessert. They're like it's like a daytime treat, which is like that, and croissants are like they're daytime treat things. I don't know. Interesting.
I'm going to give you a little pro tip. One of my favorite things to do after I work out, after I lift some weights, grab a protein shake and a donut. Oh, it's the best. It's the best post-workout. Get that sugar back up. It's amazing. Yeah. So we digress, talking donuts. The reason we bring this up is because Victoria was nice enough to bring donuts to the office today on this Friday. And every time I see that box, I'm just so pumped. Rabih, I've already had one, and I will probably have one after lunch as well. Okay, let's jump in. How should we decipher today's market headline? Rabih, what's going on with the markets?
Yeah, and another type of drug that's supposed to hype you up other than sugar is market headlines. They try to come up with words that get you as jittery as possible. So let me read you the market headline. This is what I woke up today. And I'm like, okay, so what is really happening behind what they said? So the market headline says, S&P 500 falls 1% Friday, heads for the worst week in a year on tech selling, weak jobs report. This is it. 3 major categories together. It's a doomsday. So let's look at it. The first portion is that the S&P 500 falls 1% on Friday. If you're aware of the distribution of returns of the S&P 500, you would only me, but you would know that.
How dare you, sir?
So
if you nerd out on this like Rabih does,
you would know that it's a distribution where usually the daily return is around 0.5% for the day, with a standard deviation of like 0.7. So if we assume the returns are normal, which is a big assumption, 68% of the time, the returns on the S&P 500 in a single day are going to be between 1.3% and minus 0.2%. So this is 68% of the time, every single day, we're there. And now we're only down 1% and it's making headline. We are at the average of what the distribution should be doing and we're making headlines. So that was the first red flag. I'm like, better be donuts at the office because the market isn't good.
But this is... You're like, I hope there's donuts there to eat my feelings. But this is what the media does, right? Because their job is to get you to click. Their job is to get you to read or to be like, they're not going to say the media would never get any readers at all. Like this, whatever this headline came from, whatever the publication is, if it just said average day in the S&P, no big deal, nothing to see here. Like, so I think we're always going to reminding people of like, their motives are different than ours.
Can I give more context for this, similar to what you were saying, Rabih? Ben Carlson, I think he published this stat recently. On average, there are 31 down days of 1% per year or more. And so again,
a month's worth.
Yes. Yeah. Like you're always going to have these. Again, that's every year on average. So there's years with 40 or 50, there's years with 20, but it's like 31 a year. Yeah. You're going to get 1% or more down days. So yeah, very typical what we've seen.
You know what? You know what I hate about this the most, Robbie? This headline, really quick, and I know you're going to break this down even more. But when the media does this, where they say heads for worst week in a year or worst blank since 08, or like with no like they're trying to make this seem worse than it is. It's so obvious.
Yeah. So on the second topic, heads for the worst week in a year on tech selling. So yes, we know they've been selling tech, especially that Nvidia, as we discussed last week, didn't have really good earnings. The stock price crashed 8% afterwards, etc., etc. But if we actually look at what's the total drop for not only the week, but since the peak, since the most recent peak, which was in August 21st.
Yeah, yeah.
We're down like, hold on, I lost the page. Sorry. We're down around 5.5% on the Nasdaq, around 3.6% on the S&P, and 2.44 on the Dow Jones, which are not like the worst, because back in August 5th we had a larger drop down. But we're saying, what they said is that it's heads for the worst week, aka if you take what has happened in the first 2 hours of the day and then you extrapolate it for the remaining 6 hours where the market is open, then we're gonna be ending the week
It's on
as
its
the
way,
worst
though.
week.
It's on its way.
And I'm like, I open it, it's like I look at this every single day. Is it really the worst week? Like August was worse, and March 2023, when they said a year ago, was worse. What is happening? And I just noticed that it was an extrapolation. I was very disappointed. I was like,
It's like that's like a basketball player in the first quarter getting 20 points, and they're saying, you know what, he's going to score 80, right? That he's on pace for 80. It's like, well, he's probably not scoring 80 points, right? They're just extrapolating out an extreme set of one day or one small data set.
Listen, before I got my daughter off to school this morning, she was yelling and screaming and crying at me, and I was like, "We're headed to the worst weekend in a year."
So it started off bad.
We'll see what happens at the rest of the day, but I might be headed for the worst. Yeah, the worst week too.
So, and you guys get the point. And the last one was weak job reports, which I think is the most important one, which actually better explains the behavior in the S&P, in tech selling, et cetera, as we go through it. So when it comes to job gains, we got the unemployment rate today, and we got the non-farm payrolls, which is how many new jobs were added in the last 2 weeks in the economy. Unemployment rate ticked back down to 4.2%. Up from the 4.3% that it was at. So we're just saying that maybe July was a blip in the data. August we're still at 4.2. Hopefully it does not accelerate upwards.
Stabilizing, yeah.
Yeah, if it's stable for a couple of months, that's good. Giving the Fed some time for, the September 18 meeting to come, and them having to start cutting rates. Non-firm payrolls. So here's the thing. If you expect your economy on a real terms, the real GDP, to grow 2% every single year, it means that every single month you should be adding a certain amount of jobs. It's usually around like 170, 180,000 jobs added. The expectation for July is that we would add 161 jobs measured by the non-farm payrolls. They only came at 142. And those are measured by how many job postings there are, how many people got off unemployment because they found a job, etc., etc. They aggregate the data, and it looks like only 142 versus 160 jobs were added, and this just fuels it up because the labor market is cooling now because the supply is dwindling. And our problem has always been that there was so much supply. There was so many job openings compared to the people who are unemployed. The unemployment rate has been ticking up. So on the right-hand side of the equation, the number of people who are unemployed is increasing. But also now on the left-hand side, the number of jobs available is not keeping up with its historic pace. It's now slowing down. So there's going to be at a point now, faster than what we expected a couple of weeks ago, where they're going to come in balance, or we will have more unemployed people than there are jobs available. So with that happening, there was the 10-year treasury dropped, and then the S&P fell, and there was a tech sell-off, etc., etc. But if we want to put this in an economic narrative, what does it say about investors? Because markets really, changes in prices reflects what investors think. So it seems like the labor market is softening from an economic narrative. The Federal Reserve has to go in and intervene, cutting interest rates. If they are slow, this might cause a slowdown or a recession where companies are going to be hit differently. And this will increase our uncertainty on which companies will be able to ride that wave better or withstand that storm. So from a prudent investor's perspective, you would want to diversify your portfolio. And given that tech has had a really good run over this year, you would want to diversify away and buy other asset classes. So all this tech sell-off that we've been seeing is a matter of portfolio rebalancing. And with respect to, and given that tech is the largest portion of indices lately, any sell-off out of tech, even if you're redistributing it into other stocks, at an index level, will show a negative print. And this is what we're seeing on the S&P 500. The last point is like, oh, the treasury yield on the 10-year dropped because there's a slowdown. Well, this is pricing in expectations that the Federal Reserve is going to be aggressive in their interest rate cuts. We know that the short end of the yield curve is fully determined by the Federal Reserve. It reflects the Fed fund rate, which is currently still till today at 5.5%. But the 10-year yield has been fluctuating for the last year between like 4.5 and 3.5, which we're at. Right now we're at 3.6. This one is determined by two things: our expectations of what inflation is going to be and our expectations of what the real economic growth is going to be. If the economy is super strong, we have a strong print of real GDP growth above 2.2%, 2%, 2.5, etc., real yields will go up, pushing the 10-year treasury to go up. But if we have a slowdown where the Fed has to come and intervene, we would price in cuts. So it's a battle between whether we think the economy is going to be super strong or whether the economy is going to be too weak that the Federal Reserve will indirectly keep the 10-year down. So it's just a reflection of all this money movement that's happening from portfolio managers trying to diversify away ahead of the uncertainty that's coming our way.
So can we summarize that just really quick, Rabih? I think this is a really important point for people listening to understand. We talk about the yield curve a lot. And again, just to summarize what you just said and tell me if I'm wrong here, but the short end of the curve, very straightforward. The short-term rates impacted by the Fed. That's what the Fed is controlling. And we emphasize this all the time because when people just say rates, they use the term rates. It's like, well, what are we talking about here? Like, rates are going up, rates are coming down. So, for example, when a dentist says, "Oh, the Fed's gonna," I'm hearing or I've read the Fed's gonna cut rates, and so mortgages are gonna get cheaper, or like maybe I'll buy a house next year or whatever. We just want to emphasize that there is usually a correlation there, but the Fed is not controlling mortgage rates. Those are two very different things. So the Fed's controlling the short end of the curve. What you're saying is on the longer end of the curve, the 10 plus year is really impacted by market dynamics, supply and demand, and money movement. Is that fair to say?
Correct.
Okay. Jake, any thoughts on this at all?
Not really. I mean, this is like Rabih summarized it a bit at the end, which is people are just uncertain. They're doing some rebalancing. We talk about stock markets going down and a 1% drop in a day. It feels like this is going to happen more over the next couple of months would be my guess. Just some more uncertainty, some more volatility. I think, yep. Buckle up. That's just probably the type of fall we're in for, it feels like. And so, yeah, I just think this is a bit of a foreshadowing of things to come. I did have one somewhat tangent topic just to this, Rabih, what you said, just to talk about stock market dropping and things like that. The NASDAQ is down, what did you say, from its highs, 5% or so?
From this recent peak, 5.5%.
Yeah,
yes.
5.5%. Which again, the NASDAQ, for people who don't know, it's like 100 big tech stocks, right? Kind of in the index there. I always just like to point out that's the benefit of diversification here. Like you might say, oh my gosh, 5% is quite a big drop. No one likes to see that. But if you were holding individual tech stocks in your portfolio, let's say NVIDIA, I think NVIDIA is down 25% from its peak, which was about end of July, August time. And so that tends to happen. The benefits of diversification, even these 5% drops, even though they're not super fun, they are often better than the underlying securities or some of these bigger tech stocks who, again, if you have a portfolio like NVIDIA or Apple or some of these companies, you may see even bigger drops than that. So,
yeah, that's anyway. A good point. That's a good point. Rabih, are we just speaking of, going back to the yield curve really quick, are we still inverted or is it reverted?
It's too early to call it. So we look at the yield curve inversion, like the spread, on two main metrics in a sense: the 10-year Treasury minus the 2-year Treasury, and we also look at the 10-year Treasury minus the 3-month Treasury. The 3-month Treasury better reflects what the Fed is at right now. There's only a 3 months, so right now it's probably like one cut or two cuts below the current Fed funds rate in terms of like what the 3-month Treasury. So the spread is still very inverted. We have a good way to go. As the difference between the 10-year and the 2-year, expectations for the 2 years, the 2 years are already reflecting in like a cut, a 1.5% cut already. So it's been uninverting because the 2-year has been dropping, not because like the 10-year has been increasing. And it's like teasing the zero line. Like last time I looked at it, it was like minus 0.04%. Like
it's been verting instead of inverting. It's been verting.
Uninverting, but it's not really definitive yet.
Yeah.
The market will definitely talk about it once it like does it. It's uninverting within intraday, but that's not enough. You need an indicator at close for that to happen.
Well, we've been inverted for 20 plus months now, something like that.
Yeah, around 700 something days, which has broken a record. It's the most it has ever inverted. Usually recessions happen when it's uninverting. So if we're in a recession, according to that metric, we're already now in a recession. We don't know about it. In a couple of months, we'll say, oh, the recession started.
Yeah.
According to that metric. But the dynamics of how we're dealing with this economic struggle after rapid inflation, etc., is also new. It's not the usual of there's a shock to liquidity, the yield curve inverts, and we're coming out of it, and this has repercussions.
Yeah.
It's a different story. So it might validate and keep its predictive abilities. It might not, but given that everyone is aware that this situation, monetarily speaking, is different, not a lot of attention.
Yeah, and it's not even a direct. We've talked about this on other shows, and I think we've written about this, that the yield curve inversion is not a perfect metric for or predictor of. There's been several times in history that it's inverted, gone back, and been totally, and we've never had a recession.
There are no perfect predictors.
Of course. The other thing that's interesting, and we can move on, is the unemployment rate dropped back down to 4.2%. We talked about the SOM rule, right? When it hit 4.3, it triggered that SOM rule, which, again, Rabih, tell me if I'm wrong here, but I'm going off memory. It's a deviation of like 0.5% from the trailing like 3-month average, right? So when it went to 4.3, we triggered that SOM rule, which is actually, history has shown, a much better predictor of a recession than even an inverted yield curve. But what's interesting is now we've kind of come back out of the SOM rule. So it's kind of like, if all of a sudden we've dropped back down to 4%, is the SOM rule not like it? I guess I don't understand how that works. Like, it was triggered, but now it's untriggered. I don't know. It's interesting.
Yeah, they're more of like perturbation, if that's the right word, rather than like a noise signal.
Sure.
It's a small like deviations in the data. It's not a sharp increase on the monitor to tell you, oh, here's the signal.
Got it. Okay.
We're looking at it too closely. We just need to take a step back, and when it actually turns red on the screen, we would say what it is. I think we're getting ahead of ourselves.
That's an awesome point.
Yeah, it's a good point. Okay, let's move on. Rabih, anything else on this?
Nope.
I was sorry. I have one quick question. This is more for my own knowledge, and I'm guessing people out there want to know as well. Can you give a brief description of why I've always wondered this. Why do we break down payrolls by non-farm versus farm? What's the point there?
It's interesting. And also the naming of it makes us feel like we still live in an agricultural society.
Yeah, that's what I'm always curious about.
Which hasn't been so far. But because, farming depends on the seasons, right?
Sure.
And that does not depend on the business cycle. So if you want to measure whether a business cycle is in an expansionary phase or in a recessionary phase, you would want to look at jobs that have a high correlation with it. So that's why they exclude it.
It's like in winter months, if like farm payroll goes down, it's like, well, that's not a sign of a bad economy. It's just because it's the winter.
We'll be doing Christmas spending. Well, farm payroll.
Yeah. This is the same reason why we're taking out food. Like when we take out like food and energy out of inflation or inflation readings, right? CPI is that kind of the same thing. It's too cyclical. That makes sense. Okay, moving on. So, is the government coming for your gains? And of course, with a Z
Yes.
specifically, that's for Ryan. Ryan has said he always has wanted his podcast nickname to be Capital Gains with a Z. Okay, so we wanted to talk about this. This has been something that's has been floating around for really since Biden took office. This idea of this unrealized investment gains tax. What has been deemed as the billionaire minimum tax. And so I thought and I saw another article about it. Obviously, this is a lot of big stuff coming out with who's proposing what as we get closer to the election. As always, we are not trying to get political here, but us being investment advisors managing quite a bit of money, we thought this was interesting. This is something that we wanted to talk about. Jake, you were super excited to talk about this. I think you've got some thoughts on this, but just want to hit this kind of summary. So what the unrealized investment gain tax is, one of the proposals that's been thrown out there from the Democrat side is a 25% minimum tax on total income. And this includes so-called unrealized gains or asset growth that exceeds $100 million. So there's a couple of things we got to get nuanced with on this, or like dive into like what this actually means, because I think it's really a little bit of fear mongering when people are like, oh my gosh, they're coming after, like when a dentist is like, they're coming after my unrealized gains. Like how can they do this? It's like, well, to be fair, I don't think there's a dentist out there that's worth over $100 million. I'm just going to guess. Maybe like the person who started Heartland. I don't know. So that's the first thing. This is for right now. They're saying specifically this is only going to impact if they even get this through, which, by the way, they won't. And we'll talk about why. But this is for anyone who has investment gains over $100 million. So I'm going to stop there for a second, get your guys' initial thoughts on any of this.
Well, yeah, to clarify too, right now we do not tax unrealized capital gains, right? For example, like if you own a home and you bought it for $500,000 and you lived in it for 10 years and it grew to be worth $700,000, you're not taxed on that $200,000 in gain until you sell your house, right? This works with stocks or any other type of asset of business. So that's like what the current structure we function under. The proposal for this rule, right? I think the intent behind it is everyone just wants to tax the rich. Like, can we find a way to tax the rich, right? And this is one possible solution that people are throwing out, like to do there, right?
Yeah, because I think to that point, let's be honest, most billionaires or centimillionaires, right? Which, by the way, I didn't know this. Do you guys have any guess, Jake? Rabih, I think you already said it, Rabih, before we went on. Jake, any guess how many centimillionaires are out there? So assets or net worths of over 100 million
in the world?
America? In
America?
Mm-hmm. I didn't know that.
500?
10,000, over 10,000.
Okay, I was way low.
Which
10,000.
I thought was actually seemed kind of high. I was like, whoa.
Yeah, that probably seems more right. 10 grand. Okay, that seems right. Yeah.
So over 10,000. This is, by the way, this is as of June 2023. So it's probably more now. Mm-hmm. But over 10,000, almost 11,000 centimillionaires in the world. But to your point, Jake, I think the reason they're doing this is exactly what you're saying is people at that level of wealth, they're very, very like asset focused, like, or they're very, very like asset heavy. Stocks,
they're not really making a salary.
Yes. Private businesses. They're not doing this off of salary. Private businesses, whatever it may be. But a lot of their net worth is sitting in these assets that have a lot of probably unrealized gains on paper. Mm-hmm. So I think that's kind of one way they're trying to go after, go after these people to get taxes out of them.
Here's the thing: you can't tax unrealized gains. You just can't.
It's not going to happen.
It introduced it like it's just from like a logistical, technical standpoint of how do you do this? How do you value these properties? How do you value all these businesses? Do you get a valuation every quarter, every year? It's just an entire mess to try and do this and figure out what something is worth without having to sell it. Again, a lot of people are freaking out. I'm kind of back on Twitter slightly in a small way now. People are freaking out about this. Which,
yeah,
of course, crazy thing happening. Yes, this would only apply to the very rich, but even like people are worried like, oh, it starts with the rich, then it comes down to us. That wouldn't happen. Again, it would bankrupt most Americans. If you bought a house for $500,000 and then it grew to be $700,000 in the course of a year, and you had to pay 25% on that, you would owe $50,000 in taxes, and people just can't pay.
Or you'd have to sell your house, right?
Yes, it just does not work, right? This whole thing doesn't work here.
Here's also, think about this, and there's some quotes here from some people talking about this, and Rabih, you mentioned Mark Cuban. Mark Cuban went on recently to CNBC and talked about this very thing, and basically just saying, like, this is not going to happen. This isn't even a thing. No. But think about what it does to the stock market. To your point, Jake, like take the house example out of it. Say you bought NVIDIA a few years ago, and all of a sudden it blew up to what it is now, and you're sitting on all these unrealized gains, and the government comes knocking saying, okay, you've got to, what do you have to do? You either have to take cash out of your pocket and pay those taxes, or you have to sell NVIDIA.
Yeah, or when do we take the gain? So is it like by the December 31st deadline? So if NVIDIA skyrocketed and you have a huge gain by December 31st, but then it dropped 30% by the time you pay your taxes in April, do you still owe the money on that gain? Like, it just logistically, it doesn't work. It would be a mess. You cannot do it. One thing I've heard, just quick, I want to get Rabih's take on all of this, but just one thing I have heard is the reason this is brought up is a lot of people complain about the rich not paying their fair share in taxes, right? A lot of this is because you said, Matt, they are asset heavy. They will take loans from their assets or different things there, or they'll pay capital gains rates, which are at 20% as opposed to like a 37% ordinary income tax rate. And so that's why people are complaining, like, how can we tax these people more who have the most money? I thought an interesting idea was, can we just have people start paying taxes when they're borrowing from their assets, which I think is an interesting idea.
Yeah.
Right. Where it's like, well, that's a lot of people now. It's like, I'm going to get away from taxes because I'm just going to borrow against a brokerage account or borrow against a real estate property or something.
So I'm so glad you brought this up. I do want to get Rabih's take on this too, but let's take a quick step back and explain what we're talking about here.
Yeah, do it.
This is a great opportunity here because we hear a lot of talk around where this comes up a lot, especially with dentists, is what is pitched a whole life policy, right? Insurance policies are often sold as this be your own bank type strategy. And so a lot of times dentists will come to us and say, oh, like, I wanted to get into this whole life policy or this permanent life policy because I can borrow from it. Just really quick, you can borrow right now against basically any asset you have. That's all it is. It is a structure right now in place. You can do it with a home via a HELOC. You can do it with the whole life policy via the insurance company. You can do it with a brokerage account. You can, if your car is paid off right now, by the way, you can go to most credit unions or banks if you have no loan on that car, and you can go remortgage your car basically and get a loan against your car. All it is a bank saying, we are going to use your asset as collateral and we will give you money. Jake, what you're saying is right now, if you do that, you're not taxed on that money.
That's the benefit, right? It's like, I don't have to sell these assets and incur capital gains. Instead, I can borrow against it, and then I'll just pay it back with gains or things over time. And so I'm avoiding the taxation of it.
So very wealthy people do this all the time. They've got all these assets, especially when cost of capital was low.
And the interest is tax deductible, right?
I believe so. I guess it depends on what the asset is.
Okay. Yeah.
Yep. So like, it's actually a good question. So like, if you do it with a HELOC, they've changed some rules and laws around this. Unless you're itemizing deductions, it would not be deductible. Mm-hmm. But again, a lot of these wealthy people, the wealthiest people in America, they are doing itemized deductions. So oftentimes it is deductible. Mm-hmm. But either way, the biggest benefit of it is you maintain that asset. So let's say it's a brokerage account. You maintain all of your investments in the market. You are able to pull out, let's say 50% of the value of that account tax-free, and then you can use that money to do something else with it. That's what you're saying, Jake, is right now it's not taxed, but possibly we make that.
I've just heard that. I thought it was actually, you could go down the rabbit hole of what the implications of that would be, but I thought it was an interesting idea. Like, if we want to try and tax some of these bigger assets, maybe keep people from borrowing from this stuff. I thought it was interesting.
Let's bring Rabih in on that. What do you think, Rabih? He's
like
I am ready to go.
I like the ideas you guys covered. I'm actually going to propose like a different whole perspective on how we can look at it. I'm flipping the table. Instead of us looking at it from someone who has $100 million and freaking out that the government is coming after his capital gains, I'm going to still keep the investor hat on. And economic, I'm like above any political party. I'm thinking of proper government, fiscal responsibility. This is the, where the domain where we're going to have this conversation. And the whole idea of raising taxes on wealthy people is to increase revenues coming into the government, because putting all the fairness aside, which part of the society should be paying more taxes, putting all this aside and discussing whether the government is being fiscally responsible, are they bringing in more money than they are spending, are they continuing to put themselves into deficits year after year? As an investor who would want to invest in treasury bonds and treasury bills, thinking of a government that goes into a 1.5 deficit on average every single year with a debt to GDP ratio of 100+%, I wonder whether tying your sources of revenue to something very variable and fluctuates a lot, like the amount of unrealized gains that's coming from a fluctuating stock market, is the prudent way to offset a very known ahead of time fixed amount of debt that has to be paid every single year in terms of their treasuries. So right now, I am going to be, as an investor, be lending money to the government, knowing that they have a fixed amount of liabilities that they have to cover every single month, but their sources of revenue are fluctuating with the business cycle. That mismatch between the risk profile of the liabilities, which is the treasuries that are due that the government has to pay back, and the sources of revenue, which is our income tax, payroll tax, etc. On top of it, this pseudo wealth tax that is very fluctuating makes me worried, because what if there are periods where there's a very hefty tax bill for the government, like in 2028, where a big portion of our national debt is maturing and has to be rolled over. And in 2028, the stock market crashes and you're not making a lot of revenue in that year. From a government perspective, that would actually create higher interest rates, because your belief that the government is going to be able to pay it back actually decreases. Your worry increases. So from a investor's perspective about the fiscal prudency of such a move worries me. I'd rather immunize the debt that the government has. Every single dollar they borrow is offset by a guaranteed dollar that's coming in, not something tied to the stock market.
Robbie, I love that you just said that, Robbie. There's an exact quote from Erica York. She's a senior economist and research manager with the Tax Foundation's Center for Federal Tax Policy. And she says, right, what you're saying, she says it in one sentence, which says, this meaning referring to this potential change in taxes. She says it moves in the opposite direction of sound tax policy. That's exactly what you just said. Like, and let's be honest. Maybe I'm being cynical, but no one proposing this on either side of the government, I don't care who, what side you're on, they know this isn't going to happen.
They don't want it to happen. Yeah,
they don't. And I hate to say it, this is a PR move.
Yeah,
this is the problem with politics. Is one of the problems with politics is this is not a policy they actually think is going to put in place. But what this does provide them is kind of goodwill with the people of saying, "Look, we're going after them." They know it's never going to work. They know it's not practical. Robbie, everything you just explained is exactly right. Like, this isn't. They're not going to get this in place. And Jake, you already said it. Just practicality wise, there's no way they can even implement. How do you implement this?
You can't tax people on money that they don't have, essentially, is what you're doing here.
You can't.
One quick aside I just wanted to make here is a lot of this too is, again, we talked about the rich, a lot of assets. I think it's like, right, the 1% of Americans own like 90% of the total stock market, right? So that's why they're trying to go after kind of assets in the stock market here. I hope this isn't a political statement, because it's not meant to be.
We can edit it if it is.
We can edit it out if it is. I would rather go down with capital gains tax than up, just for the sake of, I want to encourage more people to invest and save their money. I think that's good policy just for capitalism and for America. Like, I would want to encourage people to actually save and invest more, rather than increase capital gains or other types of investment taxes that discourage people from putting their money away and saving it. Anyway.
I don't think that's crazy political. I think that's just policy that you're. Maybe we're going to get in trouble here.
Yeah,
but
I don't know.
But I would agree with that. I think owning homes should be more incentivized via tax benefits. I think they should make that more readily available. I think capital gains should be kept where they are, or even lowered. To your point, I think we should make incentivizing people across the board to invest more rather than disincentivizing them with more restrictions or taxes. I totally agree with that.
Yeah.
Rabih, any final thoughts on any of that?
No, it's just that historically we're at the lowest time tax rates has ever been, and we're still wanting them to be lower.
Well,
Yes, Rabih, we hate taxes.
I know, I get it, but
by the way, I'm not. No, Jake, I don't think you're saying this either. I'm not sitting here saying like taxes are too high, whatever. I'm just saying, I think what you're saying, Jake, if you're going to move one direction or the other, it would be down. And to that point, Rabih, it's really hard to raise taxes in America, despite what anybody says. Like, you don't raise taxes in America because, let's be honest, across the board, across the political aisle, at the end of the day, everyone hates taxes. So that's just a fact. And it's really difficult. And if you look at like you're saying, Rabih, if you look
historically, we've gone down.
If you look at over the last 50 years, taxes have only come down. So, okay, we will move on. Final topic here. Final question. Are you waiting for your parents to die? I loved this.
This is a bit of a hard pivot.
This is a dark podcast.
It's become dark.
Are you getting it?
Jake, tell us more about this. Are you waiting for your parents to die, Jake?
I am not. But speaking of rich people, really rich people, baby boomers, if you know about them, I think it's become common knowledge now. Again, baby boomers have had obviously they're one of the oldest generational cohorts in our country. They have the most wealth of any generation of all time, right? Even inflation adjusted, right? The baby boomers currently they have the most wealth out of any other generation in the history of America. Now, we talk about this a lot, and I think a lot of times like, oh my gosh, it's so unfair. The boomers had it so easy. We're all struggling now. Well, I guess you could say one of the benefits of the boomers becoming so wealthy and their wealth keeps increasing is eventually they are going to pass on, unfortunately. And that money has to go somewhere, right? It doesn't go to the grave, them. It is passed on to different people. USA Today had a stat. They did a survey recently where they interviewed millennials and Gen Zers, asking them how much inheritance do they expect to receive from their parents, right? Essentially, baby boomers or even some Gen Xers here. Almost 70%, 68% of millennials and Gen Zers said they expect to receive an inheritance. 70% of people? That seemed quite high to me. The average balance they expect to receive is $320,000 from their parents, is about the average amount. Again, maybe that's brought up by a little bit there, but they also said over 50% of millennials expect to get $350,000 or more. So over 50% think they're getting more than $350,000. Again, survey results, you can take this with a grain of salt, whatever. I just thought it was interesting that the majority of people are expecting to get an inheritance, and it's not a small sum of money, especially as we're living longer. Again, even if you don't expect none of us are hoping for our parents to die. Maybe some people are. Again, there's probably extreme situations here. You never know. But I just wanted to ask you guys, we've never really seen this before. I think why this is noteworthy is boomers are almost like the first generation who they haven't had pensions or things like that, and they're living longer, where they've been expected and had to contribute to 401ks, build their own wealth to be able to retire on. So we haven't gone through a huge wealth transfer before, really, in this country. This is one of the first times we'll see it.
And
over
the biggest.
And the biggest.
Yeah.
Yeah, over the next, 10, 20 years, whatever. I'm just curious if this changes how people think about personal finance or saving or investing. Like, I wonder if we get to a point where, again, getting $300,000 is not a small sum of money for a lot of people. I don't know. Do you guys have any thoughts on this? I'm just so interested on does this make people save less? Are people more comfortable? I think we've thrown on the stats too of like a lot of parents are helping kids with down payments now in houses. Like, does this intergenerational wealth just become more of a thing that kind of a tide that raises all boats? I don't know. Yeah. I have a lot of thoughts on it. I don't know if you guys have any initial things you wanted to say.
Rabih, I don't know if you have initial thoughts.
Yeah, this resonates closely to like the concept of moral hazard. Moral hazard is like if you have insurance, you're more likely to go put yourself in situations where that insurance is going to pay up. And it's like if you know that you're going to be receiving on average $300K, you are more inclined to not save just because it's coming. And that bothers me because it's not the right way to think of it mathematically. That's why it bothers me, because $300K in the future has a much lower future value than $300K saved up right now. And I think this would actually hurt people more than help them, because they are deferring savings. They're deferring establishing habits that actually puts them up to be successful financially in the future. That's my only beef with it. But
Yeah, I think the key word you used, Jake, in these surveys and this discussion is expectation. Like
Yeah.
expecting. And
Yeah.
Rabih, it's exactly what you're hitting on. I think that's a dangerous game to play. To your exact point, Rabih, I've seen the dark side of this, of where I've had clients and or just dentists I've talked to who literally will openly say,
I have money coming my way.
I have money coming my way. And we're talking, I'm thinking of one in particular that is significant. Like, this person is waiting and expecting multiple seven figures in inheritance. And as a result, is, to this moral hazard point, Rabih, is gone off the rails with spending and is just not disciplined even a little bit, and acting as if that is their retirement set, ready to go. And I have tried and tried and tried to talk to this person and just say, listen, you can't, there's so many things that could happen outside of your control that could completely blow this up. By the way, the habits you're creating right now, let's say you even do inherit the money you say you are, you've gotten so out of control that even the money you are inheriting is not enough to maintain the lifestyle you've now created because of this moral hazard, Rabih. So that's obviously an extreme example, but I do think the idea of expecting it is the problem.
Yeah.
That's the issue here for sure.
That would be our stance, right? From a good financial planning standpoint, do not expect any money from parents. And if you do, count it as a bonus. I do wonder, though, at some point in the future, again, we can get into, like, does this create more kind of a difference between the haves and the have-nots, and, kind of generational wealth and things like that? We can get into all that. I'm just curious, like, economically, do we get to a point where most people, like, as we go generations from now, we're just expecting more wealth, and you're starting from a baseline of a certain amount of money? Does that inject more money to the economy? Maybe your parents weren't spending it, but you feel comfortable spending it. Anyway, but just a curious stat there.
Well, there's a lot, again, speaking of politics and all this, I mean, this is another huge topic, right? This is another huge narrative that is kicked around on both sides of the political aisle of, what do you do with estate tax? Like, should this be, and really right now, this political cycle could have a huge impact on a lot of this for a lot of people, because the estate tax exclusion is set to sunset in 2026, I believe.
Mm-hmm.
And so depending on who wins this election cycle, that's going to be a huge impact here. But Jake, I think the other point you made that's just really interesting, taking a step back, is something that people don't often think about, which is, again, this industry that we're in and this idea of retirement is a relatively new concept. So like you said, this is so spot on. The baby boomers are the first generation, really. And I guess as a result, millennials like me, like you guys are both millennials on the younger side.
Yep.
Like our generation, are the first generation probably to have to handle this size of wealth transition or transfer. So it is an interesting concept to say, and you pair this with what we talked about, I think it was last week, this narrative that millennials are not doing as well as their parents has been completely debunked, by the way.
Yeah.
So that is no longer the case, not to mention what you're hitting on, Jake, that we are now in line for the biggest wealth transfer ever. Let's just say millennials are doing okay.
I think we're doing okay.
Yeah.
I don't know if this is coincidentally or not. I saw they just released, like, the Labor Bureau Statistics released last month, or July's personal savings rate across America. It's at 2.9% right now.
Ooh.
Which is the lowest it's been since, like, 2008. It's a bit dipped below 3% for the first time in a while.
Yep.
We've had a steady decline since COVID. I don't know if this plays into it, or millennials are feeling like, hey, the stock market's awesome. My house has gone up a lot. I'm expecting an inheritance. Maybe I don't need to save a lot more. Some people could argue I'm feeling the pinch of inflation, right? That would be the one side of it, is living costs get more expensive. I don't know.
Yeah.
But yeah, inheritances, we'll see. We'll see how this plays out over the next, 10, 20 years. This wealth transfer is going to be interesting.
Okay, so we've confirmed that none of us are waiting for any of our parents to die. That's good.
We're not.
We're not. Please don't. You won't. Yeah. And then I guess our piece of advice here is just don't, like, as much as it's, again, easier said than done, but don't be counting on an inheritance as a piece of your retirement plan.
Here would be my advice. If your parents are planning on giving you inheritance, try to convince them just to take you on a lot of vacations with that
There
money
you
instead.
go.
How about that?
Yep.
It's like, hey, I don't need this money to just pad my investment portfolio when I'm 65. It'd be nice an extra vacation or 2 a year with you just to spend time together.
That's actually, I love that you just said that, Jake. And this is for anyone that's older and that maybe on the other side of this coin of someone who's in the baby boomer generation that is thinking about this exact thing. I'm totally with you that your kids, your family would rather spend that money with you as opposed to without you and like inherit it after you're gone. I would imagine that most people would rather have that. I know for me, with my dad, I'm like, yeah, Dad, if like I would much rather enjoy that money with you, make memories with you and your grandkids, rather than be like, oh, let's have this when you're gone. So that's a great point. I love that you just said that, Jake.
Yeah.
Rabih, any final thoughts?
Nope.
No, got it. Well, let's close on that, Jake. That was great. Okay, Jake, Rabih, thanks for being here. As always, everyone, thanks for listening. That was our 2 cents. Have a great weekend. Bye-bye.